Hi, everyone. Hey, and welcome to June. And as always, we take a step back and look what happened in the month previous. So this will be the market and economic review for May 2025. And as we typically do, we start each of these monthly reviews with what we expect the outcomes to be. Either the data continues to weaken as it continues to do until kind of the shoe drops and we wind up in a recession, which will come as a big surprise to markets. It always does. Or the data will actually show improvements, and as if we're seeing a soft landing, things start to improve month over month over month, and it begins to look a bit like a kind of like a Nike swoosh. In either case, we certainly would hope that markets broaden out, and they have a bit. What I mean by that is the previous 2 years, most of the return in the broad-based market, the S&P, was absolutely a result of all this enthusiasm around a real handful of individual stocks, the Mag 7. And it created a huge amount of concentration as they went, so went the market. But it also created huge disparities in what was happening there and everywhere else. So you would hope in a healthier market, you'd see a broadening out where other sectors, other types of securities begin kind of carrying some of their weight. We'll see in just a few minutes that we've begun to see a little bit of broadening out. Whether that results in a recession, soft landing, time will tell. As we start out, we always look at this chart, the famed leading economic index chart. I use it because it's highly predictive of recessions. What isn't known is how long it takes to go in one, but directionally, it tends to be pretty accurate. And once again, as we have seen and continue to see for the last couple of years, the index continues to weaken. And in fact, just 2 weeks ago or so, when the April numbers were released, we saw the LEI fall again for the fifth consecutive month, fallen over 30 months now. But the rate of change is actually accelerating. For the month of April, we saw a full percentage point drop, which is huge. It's one of the largest month over month drops we've seen. And that came off of a March drop, which was 0.8%. Again, very, very high. Now, some of that might be concern and chatter and reaction over tariffs or the impending tariff news. We'll see. We'll see what it looks like this month when the May numbers are actually reported. On a more frequent basis, there's other data that is released as well. If you look at the third from the top, credit card delinquencies, these are cards that are over 90 days late. More than likely, it was something more than just simply a skipped payment. But the default rate is now 12.31%. That's very high. That's almost a percentage point higher than it was the quarter before. And it's certainly higher than it was just a year ago, and much higher than long-term average. I had been saying it'll be interesting to see what that number looks like, as many folks that have embedded credit card debt might also be the same folks who have student loan debt. And now that there's a requirement to make those payments, there was a reprieve for nearly 3 years because of COVID. And there's a reporting requirement now for missed payments. I would expect that the credit card delinquency rate may very well go up. Given an individual with $1 that can be put toward credit card debt or student loan debt, more than likely it'll be put towards student loan debt. You can't get rid of that debt during a bankruptcy, but if things got really bad, you could go into bankruptcy and purge yourself of credit card debt. Also, we're seeing an uptick in default rates on commercial mortgages, specifically office buildings. That delinquency rate now is over 10.5%. It was single digits just 12 months ago. And it's only a fraction of a percent removed from where it peaked during the financial crisis. There's almost $2 trillion of commercial mortgages that are coming due that term out over the course of the next nearly 2 years. And they'll require refinancing. And in some cases, there just won't be refinancing because there just isn't the collateral. These buildings are not throwing off the same amount of rent. They don't have the same amount of tenants, and it becomes an issue. In the manufacturing sector, we've been probably in a recession for a while, although it doesn't show up in stock prices, certainly. We've seen a number of areas, segments of the country where the business barometers have been pretty negative. Chicago, which covers essentially the Midwest, dropped another 4 points to 40.5. Anything below 50 is in contraction, and the index now has been below 50 for 18 consecutive months. The Empire State showed very little change month over month, a negative 9.2. Anything below zero indicates worsening conditions. Anything above zero, improving conditions. What's lately been in the news, at least in the financial news, some of the stuff that we read regularly, real estate is starting to get really interesting. Home prices last month, by the way, this hasn't been updated for May yet. We'll see what those numbers look like, but dropped to the slowest March pace since 2009. And sales previously fell about 5.9% from the month over month. And now you're seeing inventory starting to rise a bit as well. New construction still selling well. Existing is starting to get a bit tired. We haven't seen a big dislocation yet in pricing, but as inventories go up, as sales go down, you would expect to see some movement in pricing to start moving some of that inventory. And that'll be really interesting because most consumers kind of view their wealth also based on home price. It's not just the value of their 401k. Additionally, there's been a lot of, I would call, confusing data surrounding jobs. Initial jobless claims rose. So through the month of May, that's the number of people filing for unemployment. That number was revised upward. It was higher than expected. The ADP survey for May, number of new jobs created was lower than expected, 37,000 versus 62,000. That's the lowest reported since March of 2023. And for those who are playing at home, 2023, March was when banks were starting to fail a little bit. Now, what's interesting is the ADP survey is payroll survey being processed through ADP. So 37,000 jobs created. Those could be part-time jobs. They could be multiple jobs for an individual. It's just that that person has been added to a payroll system. At the same time, the government survey, and they extrapolate certain data from a variety of sources and kind of build this number organically internally with the government. They showed 139,000 new jobs created. That was updated just Friday. And the market rallied as a result of that. In fact, most of the movement in the week happened as a result of Friday's activity. What's really interesting, and there has been a lot of talk or discussion, at the same time they announced 139,000 new jobs created for May, they also reduced 100,000 jobs for both April and March. So those numbers were revised downward. So effectively, the number of new jobs created is quite a bit lighter over the last 3 months than what we were expecting before. So we've got economic data that still continues to look weak. This doesn't look like that Nike swoosh we were talking about. At the same time, we've got really extended valuations. Stock market pricing is very high. There's this euphoria right now over the last month or so. We'll see that in a minute regarding enthusiasm over tariffs or expectation of lack thereof. Valuations have bounced back. And as a result, they've become even more extended than what we're seeing here. If you remember, this is updated quarterly. And for the end of the year, the number was 211, I think, highest ever recorded. 200 is very extreme valuation as well. And that was through March 31st. Since then, the market has rebounded quite a bit since March. So it'd be really interesting if the quarter ended now, would we be back at all-time highs or all-time recorded extensions as we've seen with respect to this market. Right now, we're just under 60% higher than long-term standard deviation. And why this is important and this value is the value of the stock market against or over GDP. Value of the stock market is what people have decided to value or price or are willing to pay for the market. If you were to buy every share of every company publicly traded, that's what it would be. And that should reflect future economic value or economic output. The bottom number is GDP, which is the sum total of all goods, services produced and consumed in our economy. So it is our current productivity. Now, what's interesting is the top number is just stock price value of publicly traded stocks. And yes, they do contribute to GDP. But there are other things that contribute as well that are not represented in the top number, but certainly are on the bottom. There are a ton of organizations that are private. Think of all the people that work at the University of Michigan's Health Center at the university in Ann Arbor. I don't know, 20, 30,000 people maybe. The amount of billions of dollars of contribution to GDP. Other smaller companies that are non-public, like my little firm here, or the US government contributes to GDP, probably 25% contribution to GDP. So when you have stock market value 2x GDP, that's extreme excess valuation. And this chart shows that when we get to these stretched positions, eventually they snap back and in a big way. We haven't had these extreme valuations all that many times, but every time, eventually those valuations get washed out. So we're coupling decelerating growth with extreme valuations. That's not a recipe for success. So best to be cautious. Returns in May snapped back quite a bit from the prior several months. Remember, we had the Rose Garden discussion with President Trump. He laid out all the tariffs, market sold off. It was already selling off. Before that, the S&P got down to a point where it had lost something close to 15% of its value. It was minus 15% year to date. It was almost 20% off of its high. And then we had this huge snapback when 2 weeks later, he decided to kick the can down the road. He didn't eliminate the tariffs. By the way, that clock is ticking, and I think it's the second week in July where that 90-day grace period has been extended to. So we'll see what happens. More than likely, tariffs will be more meaningful once again in the news cycle. And if they're anything greater than the 10% blanket across the board, the market is not priced for that. But you can see the S&P was up 6%. Equally weighted was up 4%. The NASDAQ was up almost 10%, clearly led by big tech. But at the same time, bonds were negative. 20-year treasuries were down 3.5%. 7 to 10-year treasuries down 1.5%. Gold was somewhat flat. The US dollar was somewhat flat. And we saw maybe a 3% bump in balanced stocks from going slightly negative as of the end of April to somewhat positive at the end of May. Magnificent Seven contributed. They represented about 4% of the 6% S&P return. That's about 65%. So they are still quite meaningful. If it wasn't for them, the returns would be a little bit less. And you can sort of see that by just simply the delta between where the S&P is at 6.15, the NASDAQ, which is all tech, at over 9, and the equally weighted S&P, which doesn't concentrate into those names, at just over 4. So that's where we find ourselves this month of May. We'll do this again next month for the reporting out of not only June, but the second quarter. And we'll also kind of look at year-to-date numbers as well. If you guys have any questions about anything that was discussed in this presentation or anything else for that matter, please reach out. You can simply give us a call or visit us on our website. Thank you very much. Have a wonderful summer. Be safe, and we'll talk to you in 30 days.